Gold and silver just got slammed, and no, it wasn't because the world woke up and decided inflation is solved, deficits don't matter, and central banks suddenly became disciplined. It wasn't because mines discovered a hidden mountain of new supply overnight. It wasn't because the demand from electronics, solar, jewelry, or reserve managers evaporated in a lunch break. This move had a trigger, and it wasn't a headline. It was structure. When gold and silver fall fast, people scramble for a story that feels clean. They want one villain, one chart, one macro sentence they can repeat. Dollar up, rates up, risk off. Sometimes those are true, but the fastest drops usually don't start with a macro epiphany. They start with positioning, they start with leverage, they start with the rules of the paper market tightening at the exact moment the market is most fragile. Here's the real trigger no one wants to say out loud. When an exchange raises the cost of holding metal exposure, or when funding conditions tighten and brokers get aggressive, price doesn't move because beliefs changed. Price moves because forced sellers appear. Not sellers with a thesis, sellers with a deadline. And deadline selling is the kind of selling that doesn't negotiate with your support lines. It runs through them. So in this breakdown, we're going to do three things in one straight line. First, we'd all strip the move down to the mechanics, how leverage and margin dynamics turn normal volatility into a cliff. Second, we'll separate paper price from physical conditions, because gold and silver live in two markets at once, and they don't always agree. Third, we all end with the only part that matters after a slam, the signals that tell you whether this was a shakeout, a trend change, or the first crack in something larger. If you only remember one idea from today, make it this. In precious metals, you're not only trading the metal, you're trading the plumbing around the metal. And when the plumbing tightens, the screen price can collapse even while the real-world market stays stubborn. Let's start with the uncomfortable truth that most people learn the expensive way. Gold and silver are not priced purely by jewelry demand, industrial use, or long-term monetary logic in the short run. They are priced by the marginal trade. And in the paper market, the marginal trade is often a leveraged position. A futures contract is not a bar of metal. It's a leveraged claim. You don't pay full value. You post a fraction of it as margin. Margin is a performance bond. It's the market saying, prove you can survive the next wave of volatility. The moment margin requirements rise, or the moment brokers tighten risk controls, holding that same exposure becomes more expensive instantly. And instantly is the key word because markets are forward-looking, but margin calls are immediate. Here's what happens in plain terms. A trader is long gold or silver using leverage. The trade is fine as long as required collateral stays within what their account can support. Then the requirement jumps, or price moves against them just enough to push them below maintenance levels. Their broker recalculates the account under the new rules. If they don't have the cash, they get a call. If they can't meet it quickly, the broker liquidates. Not because the broker thinks you're wrong, but because the broker is protecting itself. That one liquidation isn't the problem. The problem is the crowd. When thousands of leveraged traders face the same tightening at the same time, you don't get a slow debate about value. You get a stampede. Stops get hit. Stop orders become market orders. Market orders hit thin liquidity. Thin liquidity exaggerates the move. The move triggers more margin stress. More margin stress forces more selling. The market becomes a loop. That's why these slams feel like a trap door. A normal pullback breathes. Buyers step in, sellers test levels, price explores. Forced liquidation does not explore. Forced liquidation evacuates. It sells because it must, not because it wants to. Now, why does this matter for both gold and silver? Because they behave like cousins in the paper market, but with different personalities. Gold is deeper and more liquid, often seen as the reserve asset, and it can absorb flows with less chaos. Silver is smaller, more thin, and more explosive. It doesn't take much forced selling to smash silver's screen price, and it doesn't take much real buying to send it flying back. That SY silver usually looks like the more dramatic version of whatever stress is moving through the precious complex. There's a second structural factor that people ignore when they blame fundamentals: timing. These rule shifts and forced liquidation episodes often hit during periods of reduced liquidity. Rollover windows, holidays, thin overnight sessions, and moments when one side of the market is crowded. In those moments, the market is like dry grass. It doesn't take a big spark. It takes a spark at the right time. So if today looked irrational, that's because it was mechanical. The market wasn't voting on whether gold should be money or whether silver is strategic. The market was clearing leverage under pressure. Now let's talk about the part that makes people furious and confused at the same time. How can the price of gold and silver fall hard while the physical market doesn't act like anything changed? Because there are two versions of gold and silver trading in the world: paper and physical. Paper is a claim. Physical is the metal. Paper can be created, traded, and closed at algorithmic speed. Physical has to be mined, refined, vaulted, shipped, insured, and paid for with real cash. One is fast, the other is real. When forced liquidation hits the paper market, the screen price moves first, violently. Headlines react, social feeds panic. And then, if you look at the physical market, you often see something different. You see dealers slow to drop prices. You see premiums stay firm. You see certain products go out of stock. You see buyers step in, not because they love volatility, but because they recognize a dislocation. A dislocation is when the number on the screen stops matching the conditions on the ground. And dislocations do not last forever. They resolve. The only question is how. Sometimes paper rebounds quickly because the forced sellers are done, and the market snaps back when liquidity returns. Sometimes the dislocation widens because paper gets pushed lower again, and physical simply refuses to follow. In that scenario, the price becomes a debate. Is the price what the futures contract printed at 2:15 p.m., or is the price what real buyers must pay to secure real metal in size? This matters even more right now because gold and silver are not just commodities. Gold is a monetary reserve asset that central banks accumulate when trust in fiscal discipline declines. Silver is both monetary and industrial, and its supply is structurally slow to respond because much of it is produced as a byproduct of other mining. That means silver's fundamentals can tighten quietly even while paper price whips around loudly. And here's where the crowd gets misled. They see a hard red candle and assume the metal itself became less valuable. But a margin memo does not create more ounces in the ground. A liquidation cascade does not cancel solar installations. A funding squeeze does not reduce the need for electrical contacts, power electronics, and grid upgrades. It changes collateral rules. It changes who can hold exposure and for how long. That's why paper events often transfer metal exposure from weak hands to strong hands. Leverage is fragile. It magnifies gains on the way up, but it shatters when the rules tighten. When leveraged longs get flushed, ownership often shifts to cash buyers, longer-term holders, and end users who don't care about a daily candle. They care about supply, continuity, and replacement cost. This is also why a slam can be terrifying and constructive at the same time. Terrifying because it's violent. Constructive because it clears unstable positions that can be forced out again. The market stops being held up by borrowed conviction and starts being held by real capital. But don't confuse this with a guarantee of an immediate rally. Mechanics can keep hurting you if you fight them with leverage. A market can stay irrational longer than an over-leveraged account can stay open. The point is to separate what happened from what it means. What happened was a structure event. What it means depends on what the physical and macro signals do next. Section 3. So let's address the question that always comes after a day like this. Does a slam like this mean the bull case is dead? Or does it mean the market is being purged before the next leg? The honest answer is that it depends on whether today was a one-off flush or the start of a broader tightening cycle. And you don't answer that by staring at the candle. You answer it by watching the constraints. Start with funding and collateral. If margin requirements rise, if volatility remains high, and if brokers become more conservative, the paper market will continue to punish leveraged positions. That can keep pressure on price even if fundamentals are fine. In other words, you can be right long-term and still get destroyed short-term by mechanics. That's not ideology. That's the math of leverage. Next, watch the narrative warfare that follows. After a forced liquidation event, you'll see certainty appear out of nowhere. Top is in. Bubble popped. Speculators got wiped. Certainty sells, especially in chaos. But certainty is often a costume. The same crowd that panics you out at the low will calmly buy your metal back when the dust settles. They don't need you to believe gold and silver are worthless forever. They only need you to capitulate for one afternoon. That's why your job is not to win the argument on social media. Your job is to read the battlefield. In gold and silver, the battlefield is the relationship between paper claims and physical reality. And physical reality is not only about coins at a retail shop. It's about wholesale availability, refinery throughput, vault inventories, delivery behavior, and regional price alignment. If physical tightness continues while paper is slammed, you get a spring. The longer it's compressed, the more violent the eventual release can be. If physical loosens and inventories rebuild while paper is weak, then the slam is more likely a real repricing, not just a purge. Gold adds another layer: official demand. Central banks don't buy gold because they expect a 3% pop next week. They buy it because they are diversifying away from paper promises. When that bid is present, gold has a floor that doesn't always show up in a retail conversation. Silver, meanwhile, can look weak on paper, while industrial demand quietly keeps pulling material into fabrication chains. If that pull remains strong, paper slams become discounts, not verdicts. Here's the contrarian thought that serious people consider during these moments. What if the slam is not the market discovering that gold and silver are worthless? What if it's the system demanding relief from a rally that got too crowded? What if tightening collateral is the pressure valve? That does not require a conspiracy. It requires incentives. When one side is under stress, actions that force liquidation provide relief. Markets are not moral, they are adaptive. So the question to ask is simple and brutal. When forced selling hits, who benefits first? The forced seller loses control. The cash buyer gains control. That's the entire game in one sentence. Section 4. Now let's get practical. If you want to operate in this space without becoming a headline casualty, you need a short list of signals that matter more than today's drama. Here are the 4 that tell you what this slam really was. First, physical premiums and dealer behavior. If paper gold and silver drop, but premiums don't, that's the physical market telling you the metal is still wanted. If dealers hold price, restrict size, or pause sales, that's not a sign of collapsing demand. It's a sign of supply friction. On the other hand, if premiums collapse and sellers start undercutting each other to move inventory, that's real weakness. Second, inventories and stock changes at major vaults and exchanges. Ignore rumors. Watch ounces. Are inventories draining, steady, or rebuilding? A market with shrinking available inventory is a market where paper distortion has limits. A market with rebuilding inventory has more cushion for paper pressure. Third, delivery and settlement behavior. Are more contracts standing for delivery? Are participants rolling or demanding metal? Delivery is where paper narratives meet physical obligations. If delivery pressure rises while paper price is weak, that is a stress signal. If delivery demand is calm and inventories build, the paper market has more room to bully price. Fourth, regional price alignment and arbitrage pressure. When different regions price metal meaningfully higher, metal tends to flow. Arbitrage is the leash on distortion, but it is not instant. Financing, logistics, and rules slow it down. Still, persistent regional premiums are a message. The real market is bidding higher than the screen. Now, combine those 4 signals with one rule about risk that you cannot break. If you're leveraged, your only defense is slack, don't run tight. Don't assume today's margin is tomorrow's margin. Don't assume your broker will give you time. In a leverage market, time is collateral. If you don't have room for a margin jump and a volatility spike, you don't have a position. You have a timer. If you are unleveraged, physical or long-term, your job is different. Your job is to decide whether volatility is changing the supply-demand picture or merely clearing weak hands. The disciplined participant watches constraints, not candles. The emotional participant watches candles and then calls it truth. So here's the clean summary. Gold and silver got slammed because the paper market tightened and leverage became fragile at the worst possible time. That created forced selling, stop cascades, and a fast move that looked like fundamentals changing. But fundamentals don't change in minutes. Mechanics do. The real verdict will come from physical signals, premiums, inventories, delivery behavior, and regional alignment. And finally, 2 questions to anchor your thinking. When paper price drops, but physical conditions stay firm, which market do you trust more? And when rules tighten into a rally, do you interpret that as neutral risk management or as a pressure valve for crowded positioning? Answer those honestly, and you'll understand why these surprise slams keep happening. If you want the next breakdown the moment the rules shift again, stay close. In precious metals, the loudest move is rarely the most important one. The most important one is the move that changes who can stay in the game.